if you're on the verge of retiring or you retired, maybe we raise a year's worth of cash. Maybe that can help you sleep and get through this event and not worry about taking even more drastic action within the portfolio.
That is the recommendation. Having 1 to 2 years of cash, whatever your liquidity needs are, and sometimes whether you're close to retirement or not. But the fact that you have cash available should you need cash can often get you in the right mindset to be the cold-blooded investor that you need to be to handle the markets, right? You have to be emotionally in the right frame of mind to be a great investor. And if you're not, that's going to hurt you. And that's why partnering with a firm like ours and having advisors and investment professionals can help you navigate those waters, because you're not out there wondering what if.
Well, welcome back to another episode of Blue Chip Now. This is season 2, episode 26, and we have an interesting topic for everyone today. We're going to talk a little bit about what a portfolio manager would do if presented with a black swan event. So in layman's terms, if something crazy happens, what are the steps you go through? What are the actions you take if something happens in the markets that has wide sweeping ramifications? This is a topic that Matt brought up when we kind of were wrapping up last week. And we decided to do it as a full-blown topic this week because we wanted some time to think about it. And I think we could spend a very long time talking about this. I don't know if I teed it up properly, Matt, but does that kind of summarize what you were thinking?
Yeah, that's perfect. Specifically in this sense, the question posed to me was, what would you guys...
Posed by a client?
Posed by a client. Okay. What would you do if China invaded Taiwan? And obviously there's a ton of things we could do depending on the circumstance. However, this, what we're about to talk about isn't limited to if China invaded Taiwan. This could be, think of the pandemic. What do we do in the pandemic? This could be some other, Russia invades Ukraine. What's the thought process kind of behind the curtain? What do we do? How are we thinking? And what steps do we take to, preserve capital, but also on the back end, think about how do we make money?
Yeah. And I mean, I guess I can start by just, my brain immediately goes to just keeping it very simple. So whenever, I keep calling it anything crazy. But whenever any milestone, wide sweeping event happens, the first thing I do is just step back and lay out all the facts, right? Okay, what's happened? Why is it happening? And then you start to build this tree off of those facts. What can happen? What paths could this take? From there, that's when you can start to actually identify investments that are exposed, asset classes that might move differently. But realistically, as I start making that kind of decision tree, one of the first things I do is look explicitly at revenue exposures. So the geographic example is fairly easy because I think, you can look back to 2022 with Russia invading Ukraine. One of the first things I did with the investment committee was lay out explicitly the revenue exposure that we have to Russia. That's both directly and indirectly, because it's not like you have Philip Morris that sells a ton of cigarettes in Russia, but it is meaningful, right? And then you have companies like McDonald's that had boots on the ground stores, not to mention suppliers. Ukraine was a huge supplier of different things like soybeans, right? So you try to encapsulate the total exposure that you have at the company level, and then you start to think through what your expectations are, any decisions that will be made come after that fact. But that's kind of the first step for me, is really just getting everything in one place.
Daniel, that's totally logical. It makes sense. Lay out the facts. What as an investor, how do you deal with the unknowns? The things that, whether it's COVID, let's say it's COVID and no one really knew what the next card was in the deck. It's one thing to lay out the facts because those are the things those facts along with other investors. But what about the things that we can't understand because they're forward in the future and we don't have a crystal ball?
Well, and that's what makes investing hard, is you have to make assumptions, you have to make estimates, and you don't know if you were right or wrong until potentially years later. This is why I tell everybody I love painting. I just, 2 years ago, I repainted the entire inside of my house. And I loved it so much because you get instantaneous feedback on whether you were right or wrong. Like, did you do this right or did you do this incorrectly? Instant feedback, it's tangible, you get it right away. With investing, you don't have that luxury. So whether or not the assumptions and estimates that you make are correct, that's going to be a matter of playing out over the next 6, 9, 12 months. What you do, or at least what I do, is make various scenarios. I do a lot of scenario analysis in events like this. And you try to encapsulate, in the best case scenario, how does this look? In the worst case scenario, how does this look? And then in the more realistic scenario, somewhere in between, what does this look like? And you also want to call out, the people on the investment committee, Matt can attest to this. One of the things that I like to lay out for any security or any asset that we're looking at purchasing or selling on a broad basis for clients, you lay out 3 primary catalysts, you lay out 3 primary risks that could derail or be additive to your current investment thesis. So like in a black swan event type example, you just want to call out, where could we be wrong, right? Like what are some elements of this whole conversation that could lead us to have some impairment to our estimates, essentially.
And I always think, one of the things I communicated was, if you're going to expect us to make an all or none decision, meaning go 100% to cash, that's likely not going to be part of the playbook. That is
you mean from philosophically, from Blue Chip's perspective, we're not going to take a client's portfolio from being fully invested in either stocks or bonds to cash if some event happens.
Because I think from a client who is experiencing loss aversion, where the pain of losing outweighs the pain of the gains. In their mind, it's a really simple situation. It can make somebody feel like they have control. But take, for example, what we saw in the pandemic. I mean, if there was ever a time in anybody's lifetime that would have made sense to go 100% to cash. Realistically, what people would have done had they done that is probably paid a ton of tax. They'd made money. If you had been an investor from the bottom of the market in 2008, even from the peak of the market in 2007 through the beginning of the pandemic, you sold, you're likely going to generate tax. Yeah. And then the Fed steps in a mere weeks into the pandemic and really bails out the system. Interest rates are at 0. They're buying ETFs. I mean, they're doing anything they can do to prop up the market and the U.S. economy. We're sending out checks. And in hindsight, did we need to do that or not? I don't know. But at the end of the day, that had serious ramifications for investors. And it's always a massive risk to make an all or none decision.
Yeah.
So as a portfolio manager, we often think in increments. What can we do incrementally, right? So maybe it's taking 10% to cash, or leaning into fixed income or utilities, domestic businesses that generate revenue in the United States and not globally.
Matt, how do you feel about, instead of getting defensive if a black swan event occurs, actually doing the opposite, being a contrarian, taking the counterintuitive standpoint of putting my foot on the gas, getting more aggressive as pricing in whatever asset class or market goes down?
Yeah, and I think that's where you go eventually, right? There's a timeline or a sequence of events. Likely day 0, you're not thinking that way. There is a lot of market volatility. I think naturally people are hardwired to say, okay, what can we do to prevent or mitigate some losses? But then, very quickly, I mean, these events do not last long.
Well,
right.
So let's talk about that for a second, because I almost feel like we're in an environment where no black swan, and I say this very carefully because obviously we don't know how severe a black swan event can be, but I think of COVID as being pretty darn severe, right? Global top line revenues stopped, halted for 8 days. I mean, across the world, right? This wasn't just a US thing. I mean, this is a world thing. But what type of black swan event can't the Fed fix? So the reason these events don't last very long is because someone steps in and fixes the problem, right? And the Fed typically is the one that steps in and fixes the problem. So I there's not an answer to my question, because you don't know how. Okay,
well, I mean, like, technically speaking, like, the only thing that can stop a world war is one side winning, right? So like, that's something that if you had a stock market that functions like it does today back in 1940, like, that would be pretty bizarre to kind of watch. You know what I mean? especially because how much globalization has had an effect on like global markets these days. And that was a total sidebar, but that's like my opinion.
And then in that event, though, oftentimes consumer spending, is overtaken by government spending. Right. So the government spends, the government steps in, and in the example of the 1940s, World War II, the government in a lot of ways is propping up the economy because we're making planes, we're making tanks, we're making all these things that support the effort. So there oftentimes in an economy, there's going to be different sectors, or at some points, it could be the government that steps in and really supports the economy.
Yeah, and I like what you're saying, Matt, where you pause. Daniel, you said you lay out the facts, you kind of understand the severity of the issue at hand. But I think over time, if we look back at history, those who have continued to invest in dollar cost average on the way down have been rewarded over time, because the problem or the black swan event or the crisis of the moment was often short in nature, was resolved, whether it's Fed, intervention or not, but it was resolved. And over time, those who continued to plug money into the markets as the markets went lower and lower and lower were rewarded by price appreciation as the markets recovered. And so it's not always the answer, and particularly when the headlines are so crazy, right? Emotionally as an investor, psychologically, it can be almost impossible to want to put your foot on the gas when markets are in free fall.
Yeah, and I mean, I think 2022 was a really good example of that. So it feels like a blip on the radar now because we're 2 years removed from it, but 2022 was an incredibly challenging year in financial markets because there wasn't a safe haven. I mean, both stocks and bonds were dramatically in negative territory. People were very scared because they didn't know how long this type of environment was going to persist, because we were dealing with elevated inflation. We couldn't move quick enough, and we paid the price for it in markets. So like, I think to both of your points in terms of not making an all or none decision, staying committed to investing, it's really hard to do in the moment. Like in 2022, when markets are in free fall, both stocks and bonds, it changes your mindset, and you get a little bit emotional, even though that's a bias we've talked about in the past. That's really important to avoid. But if you can commit to not making all or none decisions, your dollar cost averaging on the way, if you have a process behind it that you're regimented in, that can end up reaping or providing benefits in the out years, kind of like we would be seeing today if you added to some of those things that were down, selectively 60, 70% in 2022.
Yeah, I mean, going back to how a client of Blue Chip would view not making an all or none decision, I always say, a partial decision is a great way to guarantee that you're going to be mad at me, right? So if we sell, let's say a crisis occurs and we sell some component of the stocks in the portfolio, and the market continues to go lower, well, you're going to say, I wish we would have sold more. But if the market rallies from there, you'll say, why did we sell any? And so,
or why didn't we buy?
Yeah, why didn't we buy? So but that hedging nature, like playing the middle ground in investing, can save you from making the emotional mistakes that I think are probably some of the bigger mistakes that people make in investing. It's not, I picked the wrong stock. It's, I decided to throw in the towel when times got tough, and all I needed to do was have either a partner like Blue Chip or an advisor like Matt or somebody, in my corner that helped me stay the course.
And we internally bounce ideas off each other, right? So we're talking to each other. It's comforting to have an investment committee to say, okay, what are we thinking? That way you kind of limit yourself from your own biases, internally. So that's another, I think, a great feature of having an investment committee, having a structure on how to view investments, and ultimately having differing opinions that hopefully lead you to, the best possible outcome.
Yeah, I think that's probably one of my favorite parts about the investment committee here is just that every single person that's a part of it thinks about markets very differently. Maybe not to the degree that you and Robert think about markets differently, but we definitely don't struggle with groupthink. You know what I mean? And that's important. So when you have someone that subscribes to elements of technical analysis versus someone that subscribes to elements of leaning towards fundamental analysis, it's just good to get different perspectives. And, the whole not making all or none decisions practice, like we do that. We just did that in March with Johnson & Johnson and Eli Lilly. Eli Lilly had run magnificently. We still like the business. I think the concern is that the thing is frothily valued and you don't want to buy it at the top. But if you look in the out years, we look at the primary products the company's producing and the total addressable market that continues to grow. We like the business. We just don't necessarily need to overcommit to it at a point where, we can end up looking silly. You know what I mean? And so you take half of your chips, right? And you move them towards it. You take half the chips from a different company and you move them that way. And as you gain more confidence in your thesis, you kind of keep legging into it, right? So it's not like, when we talk about this stuff, it's not like we're just talking hypotheticals. These are things that we actually do and have done consistently on a historical basis. The stuff that pre my tenure here that was going on during the pandemic, right? Like those are like challenging times and serious decisions need to be made, right? Whether it's going to treasuries or going to cash or diving in, you have to do it in a well kind of telegraphed manner with expectations and guardrails set up like I talked about earlier.
Well,
or else it's just not repeatable.
What I would add too is like whenever these big events happen, I mean, these are like media boons, right? Like everybody is reporting on the same thing.
Yeah.
Everybody.
You can't hide from that information as a consumer, as an investor. You can't hide from it.
And you have to acknowledge, because likely as the consumer or as the person, you're watching the news a little more. You want to see how this unfolds. But in reality, like you're getting bombarded with people's opinions who don't know you. Nobody ever gets on Bloomberg or CNBC and says, you know what? I think just maybe taking a measured approach, selling 25%, maybe buying some treasuries or some quality bonds makes sense. And, in a couple of days, we'll reevaluate it. Maybe it makes sense to get long. It's either, no, this is a dead cat bounce. The market's going lower, or now it's time to just leverage up and put all your money in the markets. There is rarely a balanced opinion because that opinion
it's not sexy enough for the media.
No, and there's plenty of extreme
and whether they're
opinions.
right or wrong, it doesn't matter because no one ever calls people out in the media for what the call that they made last month or 6 months ago. I do want to bring up one other point though, just regarding the Black Swan event. All right, so we talked about the process that we might take, or the stance or the lens that we might look at a Black Swan event through, but let's talk about leading up to a Black Swan event, right? So we're throwing something out there like China and Taiwan, or Russia, Ukraine. I mean, Black Swan events could be political unrest. I mean, it could be geopolitical. There's it could be a natural disaster. It could be whatever. Clients will often ask us, they'll say, well, what if this thing happens? What if that thing happens? And what we like to talk about is the possibilities of Black Swan events are endless. There are unlimited numbers of possible events out there. And if we built our investment thesis and managed money around the possibilities that could occur, we would get nothing done. So we predicate all of our approach upon probabilities, right? What is the probability of, some natural disaster occurring? Well, it's probably pretty slim. And if it does, we'll address it at the time. But we're not managing your portfolio today, wondering what the effect is of a volcano erupting in Hawaii, right? So the possibilities of what could occur and what take the average investor's mind to a dark place are endless. And it's like, is it possible that I could get on an airplane on my next trip and a door blows open and I get sucked out of the plane? Sure, it's possible. Is that going to cause me not to fly? No, I'm getting on the plane, right? So standard protocol, I'm business as usual. And for us, we have to work with the probabilities, not the possibilities.
Yeah, and I think you could say, okay, what happens if the largest tornado ever, sweeps through Michigan? Well, the financial impact, what is it? It depends. I still remember like my first finance class in college, Finance 301. professor was, I'm going to teach you everything you need to know
Did you
about.
notice how Daniel threw out my first finance class and then he put a 3 in front of it, 301? Nice. Nice. Good call.
University of Dayton doesn't always have some of these more focused,
I just
classes,
started
right?
in Econ 550.
Yeah. Well, anyways, he said, I'm going to teach you everything you need to know about finance, or the answer to every question in finance in 3 seconds. The answer is always, it depends, right? It depends. Like, how would you handle a client's assets if a massive tornado hits versus a volcanic eruption of scale we've never seen? It depends. It depends what's going on underneath the hood. The situation is going to be different regardless of what the Swan event is. That's why I always go back to having a process, right? The actual outcome of each of those black swan events from a portfolio management perspective will be different, but what shouldn't be different is the inputs to the decision-making within, that entire ecosystem, right?
Agreed.
So that's why it's really important to have that buttoned up process that can be flexible and adapt to different situations, right? The one thing I would also wanted to add, I think you mentioned how folks don't necessarily get held accountable in the media when they make, these, stark calls, right?
Yeah.
In crazy times. I think as a part of a process, you have to do some semblance of a postmortem. We do that on a recurring basis. We are consistently recognizing when we've been right, when we've been wrong, not for the sake of patting ourselves on the back or scolding ourselves. It's for the sake of learning from it.
Getting better.
Right? Getting better.
Yeah.
How did we get this wrong, or what made us get this right? What parts of our decision-making process were additive? What were detractive? I think that's probably one of the most important parts of a process that can help aid in these black swan events that is all too often overlooked, because it's not always fun. You don't like seeing when you're wrong.
So Daniel, you're saying that as a CFA, as our CIO, as an experienced investor, what you're saying is you're not going to navigate the next black swan event perfectly. Is that what you're saying?
It depends.
Yeah, there you go. Good answer.
It's the same answer.
That was a test. You passed.
Yeah. I don't know. What else, guys? Is there anything?
No, I think it's getting, clients, people to understand kind of the thought process that goes behind this. It's not as simple as pushing a button. We're dealing again with possibilities and probabilities, and really that's a great term. Possibilities are literally endless. The probability is most times these things resolve themselves fairly quick and the markets are rallying. And the worst thing an investors can do is try to time that.
I think what I would say to that is know your time frame.
You totally.
So if an event is occurring and you need cash because you have a down payment on a house that's expected to close in 6 weeks, you might need to act a little differently than someone who has an IRA or a Roth IRA that they're not going to tap for 30 years, right?
And that's a great point. So maybe if you're on the verge of retiring or you retired, maybe we raise a year's worth of cash. Maybe that can help you sleep and get through this event and not worry about taking even more drastic action within the portfolio.
That is the recommendation. Having 1 to 2 years of cash, whatever your liquidity needs are, and sometimes whether you're close to retirement or not. But the fact that you have cash available should you need cash can often get you in the right mindset to be the cold-blooded investor that you need to be to handle the markets, right? You have to be emotionally in the right frame of mind to be a great investor. And if you're not, that's going to hurt you. And that's why partnering with a firm like ours and having advisors and investment professionals can help you navigate those waters, because you're not out there wondering what if. I think that's all I have.
Yeah.
I don't know if there's anything else I can add.
Well, like I said at the onset, I think it's a valuable topic because I think it's pretty like opaque. You know what I mean? Like, these types of things don't happen very often, but when they do happen, you just have to be prepared, and you're not going to be prepared for events like this unless you put the time in beforehand, right? And that's all it is. And you know what? In crazy times like a black swan event, mistakes will happen. But as I said before, I'm fundamentally of the belief that one of the most important things you can do is learn from them, right?
Agreed. All
So,
right.
so actually, we should shout out really quick. Got 1,000 views on last week's video on YouTube.
Nice.
Pretty cool.
Yeah.
Yeah. So if you're out there watching, or you watched it 500 times or you watched it once, thank you.
Well, and it's a new venture for us, right? Being on YouTube and having the video component of the podcast. So it's audio, it's video, depending on how you interact and take in information. I mean, it's just awesome to see people that are gathering towards our content. So the one thing I can guarantee is this is just the beginning. So we'll get more out there. Shout out to Madeline, our director of marketing, who's helping us, bring this all together. And Antone, who is, behind the scenes with Madeline. They are like the dynamic duo. So shout out to those two who are helping us out on a daily basis with content and getting our material out to the market.
Yeah. And if you're just listening, as Dan mentioned, we're on YouTube. Matt talked about it. Go check it out. We put a lot of work into this, and we try to cover material that's relevant for a lot of different people. And we try to look good doing it now. And also tell a friend, right?
And generally, we're sharing charts too. So today we didn't have any visuals, but that is the benefit of YouTube. To watch on YouTube, generally we are going to share some content. So if this is your first one, stick around.
All right. That's a wrap, guys. Thanks for tuning in, and we will talk to you next week.